All right, you guys, welcome to another day. Today is April 15th. We're going to be talking about the implied move for tomorrow, Friday, April 16th, and I want to show you how we're going to actually put on a directional trade based on information that we can find in the stocks, in the futures, in the market, and in the options trading platform. So we're going to talk about the implied move, what it means for you. We're going to actually look at a pretty big technical indicator that we just found on the daily chart, what that means. So you're going to want to stick around for this one. It's going to be a little bit different video than you're used to. We're going to go a little faster. So if you're a little confused, go back and watch some of my previous videos to see what we're talking about. First off, we're going to be looking at the S&P 500. Once again, we've got the daily chart pulled up. We're going to be looking back all the way back here about a year's time. And we're just going to bring it up nice and small. We're also going to look at the SPY. So that's the S&P 500 index that we can actually buy and own stock in, run by Spider. It's going to be pretty much the same dynamic chart as it's based off the index. And we're going to actually put a directional trade on this. We're going to look at futures. We're going to look at what the CNBC Finance is saying, and we're going to see if it all correlates to the underlying premium. Okay, so what I want to show you is the move yesterday did exactly what we said it was going to do once again. So we're 3 for 3 here. We had an implied move of around 1.36%. We had said last night we were going to have an implied move of about 1.2. The direction was going to be the downside, but only after hitting some form of resistance, which is what it did do. And then we gapped down after hours. Okay, so we have a gap down after hours. We'll talk about why that likely happened. All right, if we look at the futures market, as we can paint a picture of the future, you can see that this is after hours trading beyond the chart we just looked at here. So it's going to be basically trading here. This doesn't happen here on the equities market. We have to look in the futures market for that. And you can see that we did gap down approximately 0.8%. So we're down 0.85% in the after hours trading in the futures market on the E-mini, the S&P 500 mini. That correlates to exactly what CNBC Finance is saying here, that the S&P futures are down about 0.91%. S&P 500 futures slide as NVIDIA shares tumble. Traders await retail sales data. So there's always got to be some doom and gloom news in here. Don't worry about all that. Now, if we look at the implied move for tomorrow, I'm going to pull up the options chain once again. I'm going to find the closest strike price to the actual index here. So I'm going to actually use the S&P 500 index today. And our last traded price was 53.96.62. So the closest thing to 53.96 is 53.95. This is on tomorrow's options calendar. And our call contracts are trading at 32.40, our puts at 34.50. So we have a premium based on the puts. Watch my other videos if you want to learn about what that means. Well, we'll take our handy dandy calculator, add them all up like we always do, 32.40 plus 34.50. We're going to divide that by the median to get out the highs and lows, and then we're going to divide it by the underlying strike of 53.95. And my guess is that's going to give us close to a 1%, as you can see here, a 1% implied move. And per the smartest people in the world, the market makers, that's going to be an implied move in the put direction or the downward direction. At least that is what's being priced into the market here. So we have about a 1% implied move on this index. So we can show that here. It's not going to look like very much on this big little chart. Little tiny thing there. Look at that. That's a 1% implied move. Okay. Big picture. That doesn't mean very much. Okay. But let's look at that on a smaller scale chart. So we look at the S&P 500 here, the SPY. You can see that 1% implied move to the downward direction would technically bring us into this fair value gap channel. Now, this options market platform was created right at market close here. So that implied move would actually bring us into this channel here, but it's not going to have us touch this fair value gap. What this tells me is that the market is going to try and, at least from what the options chain is saying, it's going to try and retest this fair value gap. Okay. Now, what will typically happen here is if we have support, we have an oversold RSI, not much trending in the way of volume, it's hard to say that we're going to have a huge dump into here and not meet support, because then what would happen is once we get into this gap, we have nowhere else to go but down, and that down would be to the tune of another 5%. So it's a pretty big move. And given that the volatility index has gotten lower over the past week, I don't really see that happening, but you never know. Things are always possible. Now, what is more likely to happen in this scenario is, again, we revert back down here, and then we have a mean reversal back in this direction. Okay, that's typically what happens on the technicals. But you need to stick around because I have something pretty crazy to show you. Okay, so we've just said that the index is pricing in a 1% move for tomorrow, so we're likely not to see much happen in this outside of this trend channel, but there is a higher probability, although there's a high probability of a small move in either direction to 1%, if we take that move to the downside, we have a pretty substantial loss that could exhibit if we break through this fair value gap. Now, one thing I want to talk about with that is if we look broad scale on the SPX or on the daily chart, do you guys see anything scary here? I don't like to lead with fear, but there is one technical indicator here that is actually pretty much not good, and it's going to be this guy here. Right here. And that's not working. Sorry. Reset that. Apologize. Well, I led you up to nothing fun. Okay, here we go. Go back to the day side chart. There's my arrow. What I want to show you is this right here. That is not good. What we're seeing here is called the death cross. You can Google that, but that is basically when you have this red line here is the 50-day moving average. It coming down and crosses under the 200-day moving average, which is saying that we have a short-term sell-off that is superseding the average lows over 200 days. A death cross will typically, if you're just going off of technical analysis alone of just that indicator, say that we would head down, and it's usually a pretty volatile down move if there's other news or other things to sort of trigger it. So let's take this and let's set up a trade on this. If you were bearish, which means you expect the market to go down, and you want to have some downside protection. So we're going to set up this put downside trade here, and what we're going to do is we're going to create what's called a short position, and we're going to place it right here. So if we continue to gap down and we break into this fair value gap channel, there's a high probability that if we break into it with any sort of support, we're going to continue on down, and we'll probably meet the lows here. So, or even the lows down here. Okay, so we can set up a trade. We'll set it up a little bit inside just for confirmation. And then where I'm going to take profit on this trade, if we want to stay conservative, could be here. Or if we want to be over the top, we can go here. So we can take somewhere in between. So I'm going to say like right here. Okay, we'll be conservative with this trade. And then for our downside protection, I'm going to keep our downside pretty minimal. And if we revert back up and we break through this again, I want to get out of this trade because that means we're reversing. And so I'll just bring it in, not here. I want to bring it a little higher up so that the market makers don't stop me out. And so basically what I've set up here is a put side trade where we make money if the stock falls. So if tomorrow we break down and break into the fair value gap, what I can actually do is bring that up just a little bit. Bring that down just a little bit. If we break into this fair value gap, my order will trigger at or below this price, 528.57, and I'll be making money all the way through here until I sell for a profit. But let's see how much this trade would cost. and what sort of money we'd be putting up as capital. So I picked an expiration about a month and a half out from now. Our put side ask for the 537 put is $1,691. Okay, so this trade would cost you $1,691. That is the maximum amount of money you can lose by buying an option, is the premium that you put up for it. But we can set, like I said, downside protection. So let's look at what this move would take. So that's about 648. Okay. And one thing I forgot to show you on bar chart, it doesn't show you here, but you need to find the options delta. So for this 537 out of the money put, that options delta, when I looked on my Schwab account, was 0.55, which means for every dollar the stock price moves, your options contract moves $55. That delta is constantly changing dependent on the price, but just for giggles, we'll use a delta of 55. So for a delta of 55, we would multiply it by 6.48. So our max loss for this trade would actually be $356.40 if our stop loss works correctly. And so what that means is for a trade that cost us $16.91, I think we said it was 356. So it looks like about a 5% loss in that scenario, give or take. Okay, I think I did that wrong. Was it 16? Okay, it's actually a 21%. There we go. So we're risking 21% of the money that we're using for this trade. But let's look what our profit potential would be. Okay, so we just said we're putting down about $1,700 for this trade. We're risking approximately $350 of that dollars for what reward? Let's actually do that correctly. Right there. So we set a very conservative trade, 1816. So we're risking about $350 to profit $1,000. Okay, so you can see that's where that risk reward of 2.75 to 1 comes in. And if we wanted to be less conservative, and we think that we'll break almost into this fair value gap or below it to the trend channel, you can see how our profit goes up substantially. We have a risk reward of 5 to 1. So we're still only risking that $350. We're putting in $1,700 to make the trade, risking $350 of that dollars in downside, but our profit potential would now be around $1,800 at the minimum. This is given a delta of 55, but as we get deeper in the money, that delta becomes 100. So let's assume, let's do 15 times 55, okay, and then we're gonna plus that with 15. So we'll actually end up making somewhere near $2,000 to $3,000 on this downside trade with a $1,700 entrance fee, where we would only be risking about $350. That's if the delta improved to max, which is basically 1. But given this 33.42, let's just give it a delta of, let's give it something like an 85. You can see you're at $2,800, okay? So you can make this trade as conservative or as risky as you like, just keeping in mind that we're never utilizing more than 50% of the trade in the downside. By keeping it at a 2 to 3 to 1 risk reward, you can lose more trades than you win and still be profitable. And this is the only time I really utilize this is as downside protection. So I am risking a couple $100 to make money in a downside move, and then I can take that collateral and put it back into the stock to dollar cost average when it's down here for a profit. So this is a technique that I actually used to own, over 1,000 shares of a cheaper company, and now I can sell covered calls on that company. And the only thing I really did to do that was utilizing this system. So I just wanted to show you guys a little something different today. I wanted to show you how we can set up some downside protection, what it would cost, our risk reward, the indicator showing up in the market. And then as far as tomorrow's market, like I said, I don't see us really bouncing out of this channel here of either fair value gap. But if we do to the downside, it'll be a pretty big move. If we go to the upside, we'll probably break around this high with nothing to boot over the weekend. Thanks for watching, you guys. Like, share, and subscribe, and we'll see you on the next market chart watch.